So we're not thinking about stocks necessarily. We're thinking about companies. What does a company do? How do they sell products? How do they market those products? Are their competitors better than them? Are they doing something better than their competitors? Do they have an advantage? All those sort of things that go into figuring out what a company is good or bad. That's what we're focusing on, not so much on the stocks or the share prices themselves, but the company. So what we're really doing when we are, or the word build a portfolio, that's kind of what we're doing. You're collecting pieces, like Trivial Pursuit or Monopoly or whatever the case you want to compare it to, of good companies, and you're putting these pieces in your portfolio. That's what you're doing. So the stock price, underlying company value, sometimes that's different. And companies they're doing well, can be overvalued because people want them. They're in demand. Something in demand costs more than something that's not in demand. And let's say a company is doing poorly or maybe doing poorly in the future, the share prices or the pieces of that company may go down in value. In fact, they probably will go down in value. So you want to, in general, as a strategy, collect pieces of companies that are doing good today and will probably do better and expand in the future, and get rid of pieces in your portfolio, in your portfolio account, your value, the pieces, your puzzle, your building blocks of companies that maybe aren't doing so well. The competitors are lapping them, doing better marketing, better sales, better management, whatever the case is, not expanding, laying people off, etc., and go get rid of them because they probably will keep going down. If that happens, the shares get less, the pieces are less valuable, your portfolio becomes less valuable. We don't want that. So don't just jump out and say Netflix is a great stock. I am a subscriber to Netflix and I love the movies and it's going to be really cool and somebody said it's a great company, so I'm going to go ahead and click a button and buy Netflix, or whatever the case is. Google's better than Yahoo, so the search engine wars, or the Google phone, the Android, the tablet. I'm great. I'm excited about that. So I'm going to go ahead and buy a piece of Apple or Google or Microsoft or whatever. A lot of times we discussed this in the first portion. You can use Yahoo Finance, Google Finance for that matter, any number of things to find good companies you want to buy. Think about that. You're buying a company, not the stock, not the share. We get excited about that. We look at quotes, and a quote is what the price is, how it changes. We're buying companies. Turn to a charting platform and determine the trend. Now again, we won't go over this again, but this is in the first 10 lessons of thestocksessions.com. What a trend is, where the spots to buy, retracements, breakouts, all those kind of cool things. And then draw trend lines and get ready to buy on those pullbacks. That's when the price goes up and it comes down a little bit, then it should come back up. Or on a breakout when it kind of stagnates and then breaks out. Something happened. Breakouts occur because people get excited. The company may launch a new product and they may have better earnings than expected. As we're discussing now, Netflix broke out of a really kind of a pattern, a sideways movement, and it gapped up about $80 or $90. So it's already trading higher than that. It's worth more and probably will be worth more because people are excited about that. It's expanding and other things are going well for the company.